Good morning. Happy Easter. This is Ken Long from Tortoise Capital with a review of the weekend trading report for March 27th, 2016. Pardon my voice, it's a little bit under the weather. So if it sounds like I'm talking from a trash can, it's just a head cold. Market is in sideways quiet conditions. On an annual basis using weekly RSI 14, we are in the upper end of neutral at 56 out of 100. On a 10-day basis, using the 10-day NDX, we are at 69 out of 100, so still high end of neutral. In the market mosaic, price with respect to the 200-day moving average has slipped back into sideways at plus 1.76% above the 200. The slope of the 50 has continued to improve to green bullish at 0.66, excuse me. Strength of trend is neutral at 20.3 with the ADX bull still in charge. The risk index is the 30-period moving average of the VIX divided by the 10. Comes in at a score of 1.206, so we are above the 1.0 threshold for risk on. When we compare that score of 1.206 to the last 5,000 trading days, we find the average and the standard deviation in order to compute the risk Z, which today is at 2.30. Here you see a 90-day histogram of that indicator. Importantly, we've had a low, a higher low, and now we've rolled over at 2.3 sigma and starting to roll over to this side. This is a signal in the risk Z to ensure that you are preserving the profits you've gained from the trends that developed during this reduction in volatility, which is favorable to swing trading. So this is a time to be micromanaging your stops, being judicious about how you add new positions, and don't let the wind slip away. This week we'll be adjusting the blended monthly rebalancing holdings on or about 1 April. These are the current holdings. These are the winners based on the price at the close on Friday for ETF 13, 22, and 32. In ETF 2, the theoretical exposure of the model is at 70%. The model portfolio is at 90% exposed with stops in place. No new actions this week. These are the current performances in blended monthly rebalancing for ETF 13 and 32. And you've seen there was a general retracement this last week almost across the board, but with leaders still in leadership positions. You notice how leaders are quite often the ones that give back the most, and that's to be expected on positions that are in the fat tails on either end of the spectrum. In ETF Max, again, same phenomenon. The fat tail to the right are the ones that gave up a lot of performance this week. I'll be looking for Russia as part of the energy complex. I'll also be looking for value plays on the high performers. Is this a pullback that enables a re-entry on what was a leading sector, or is this the sign that that run is done? So we'll be managing that one on a close, shorter time basis, starting with day trades, and then letting those grow back into swing trades once again. S&P 500, same phenomenon. The key leaders all had tough weeks this week, so I'll be looking for return to momentum plays in here, or looking for follow through further to the downside. So again, from the extreme location comes extreme performance. This is the market health check. The vertical blue lines are 10, 20, and 30 days worth of look back period. The horizontal purple line here is the price target at the previous all-time swing high up around 211, 212. You notice the slope of the 30-period regression line. This indicator here has rolled over. It rolled over at a reading of 0.70, not unusual for that to occur. The last time it peaked and then rolled over, we had this kind of sideways choppy phenomenon as the market tried to sort out what it wanted after a period of significant gains. And that's what we have here. The 10-period regression line slope is up, as is the 30, but both are in extreme conditions and starting to weaken. I notice that the river has rolled over and sloping up. The dragon is on the far side of the river and has been there for almost 30 days. So it's been quite an extraordinary 30-day move off this bottom. And so a period of consolidation or even retracement would not be unusual. And so now these horizontal red lines represent price targets on the way down. These were levels that used to be resistance, and then when they broke through, they became support. Now they became price targets, possibly on the way down. So this was a 12 or 13% move to the upside. And this is still an orderly pullback, just at the edge of the river, supported by the dragon. Next price target, though, would be the Bollinger Band mean, and halfway to the edge of the river, then the edge of the river. So we have some room to go in either direction, and that means, in my view, the market is coming to a critical state. I think it's a positive sign that it held the close on Friday with a white candle. It found some initial support here, so let's see what we get on that. Inside the ETF2 lens, we have 3 of the 10 major world indexes on cash signals, 7 on buys. So that brings us to 70-30 invested versus cash, down from 90-10. Inside was quiet. The S&P at 46 is better than the globals at 40. And then inside the U.S., it's the S&P at 46, the mid caps at 45, tech at 43, and lagging in the small caps still. ILF and EPP are still the 2 strongest sectors at 55 and 47 respectively. And then the 2 weakest sectors, U.S. Small caps, and then the European 350. Strength inside the sector spiders for the S&P 500, still in staples and utilities, and technology to a certain lesser extent. The world market model now, inside the U.S., weakness in the growth and in the small caps, but above average in value and in larger mid-cap blend. Japan under average, Asia less Japan strong. Malaysia, Thailand, Indonesia very strong, along with gold, Latin America, and Brazil. Everything Europe below average with the exception of the Americans. The ETF top 30, using the ETF2 lens. Gold, Indonesia, utilities, Malaysia, high dividends. More gold and dividend leaders that are greens across the board. Green and then white under strength and consistency are emerging areas of strength. So Latin America, Brazil, metals and mining is doing well. Weakness would be white and then green. That's something that was strong, and now the strength is coming out on a shorter term basis. Treasuries and consumer staples are there. Looking at the Dow. Verizon and 3M remain at the top, along with McDonald's and Walmart. Caterpillar is a new addition to the top. They're in the green and white, along with United Health. Some weakness in Procter & Gamble. The number of red elements of the Dow under strength is reduced from 5 down to 3. So I take that as an encouraging sign. Shifting to the daily report, a bundle of mechanical swing setups for gold, silver, a bunch of 5DDs, both on ETFs and the large caps, and a select number of auto framer candidates. You see how much the volatility has drained out. We're just nudged into quiet now, as you can see. Again, lots of ETF targets to shoot from. The fraud quality numbers. This is typical of a market in which the volatility has been declining on a broad basis, and now the standard deviations are small, and that leads to a favorable quality numbers. Nothing firing on the RSI2. Caterpillar and IBM just look good to me because of the outperformance across multiple time frames. Lots of good signals under 551W. These would be candidates for second day momentum on Monday. And again, lots of the auto framework with favorable reward to risk ratios to choose from. Again, a good number of auto framework candidates and lots of regression line fractal framework targets to work with here. I'm going to be looking at excuse me, Disney, silver, U.S. Real estate, I like more Brazil, and I think Nike off the auto framework charts, and from the fractal frameworks, Disney, Nike are in there anyway because of the deep value play, so I like that. United Tech and 3M and Verizon. TX, Verizon I will frame out. On the daily squeeze, I like seeing Google, Walmart, and Lowe. Those are my typical list, so I'll go take a look at those. Honeywell too, I've traded that one before with some success. When it moves, it tends to move in the tech sector. So it gives me a dozen things to look at. Now this is crucial here. So this is the slope of the 30. The parabolic is starting to roll over. This is enough of a decay that the slope of that 30 regression line has now crossed its 10-period moving average at a distance more than one standard deviation above average. And so we're at this location here in the indicator, and this is where price is with respect to the 200, one standard deviation above it. And the last time that it peaked like this was here, and we had the sideways chop. After a nice period of gains, it had the sideways chop followed by a collapse. So we've had a brilliant run here, and now this pattern's nearest neighbor is here, and then the one before that is over here. So I'm prepared for a sea change now in the market, whereas the last 30 to 40 days have been very favorable from 185 to 205 in the S&P. There's a good opportunity for this to show. And this is after, when we look at that same indicator over a 10-year period, that was one of the three best 30-day periods of the last 10 years. Ever. Really, I mean, ever. And with this corresponding fail in the volatility, or the draining of volatility out. So that's starting to set up some possibilities for system shocks. And looking at VXX, this explains our exiting the XIV swing trade last week, and the short side VXX swing trade with a nice win. So I'm posturing for a change in the weather. Just going to flip through some stats for your use. So this is looking at those regression line slopes on a standard deviation basis, a z-score basis. You see the 10 has rolled over with three lower highs. 30 has rolled over after excursion out to 3 sigma. The 90 has rolled up and come back in towards the river. This would be a natural place for a pause to occur. The last time we saw this kind of behavior was back here, where after, again, a period of gains, we had the 90 come up into the river, the 10 getting a little weaker, and then the 30 having rolled over. And so this period of time from here through here is the kind of price behavior I would not be surprised to see. So that's where I think we are, that kind of probable market condition. would not surprise me, especially as we start getting closer to political decisions. I would expect volatility to increase. So some frog stats for your reference, polling days for your reference. And that's everything that I wanted to cover. I'll be framing up these trades and posting them for the swing trade workshop and for the chat room. We'll look at each of those in detail along with the open positions we have in the swing trade portfolio. So this is Ken Law from Tortoise Capital. Enjoy the rest of your Easter. Take good care of yourselves. Keep your risk measured and your powder dry.